right now to talk about what he's making of all that's happening in the world. Steve, hi, great to have you on ET Now. Steve, let's talk about what's happened last week. The fact that valuations did ease off a little bit and what everyone's been talking about, the bubble in the Mag 7. Do you think those were early signs that we saw last week, that maybe there is a due correction which is bound to play out?
Well, it's possible we're going to see a correction in sort of the stocks that we all know, kind of whose valuations have really gone sky high. It's interesting that profits overall seem to be doing very well and continue to beat expectations. So it's not like the story is completely negative, and some of the profit surprises are outside of the high tech sectors. So it could be even healthier if there's a broad-based support for equities rather than very narrow support. Having said that, I think what we're seeing today, the fact that the probability of a Fed cut is now close to only 40%, with maybe 70% at the beginning of last week. I think that that's having an impact both on overall equity valuations, and on the dollar and on rates everywhere. And that, if you look at the way FX is trading today, it's very risk off, but I think it's mostly Fed fear risk off rather than anything else.
If you look at the inflation numbers, that's also a bit of a concern for the market there, though we haven't got much of economic data coming in. But from the way the administration is, putting out incentives, or the $2,000 paycheck that's expected to to go to the consumer or to the citizens, it seems that inflation is still a big concern for not just for the Fed but also for the administration.
And I think you're right on that. I think that the takeaway for the Republicans from the midterms, or not the midterms, but yesterday's or last week's elections, is that it's not enough to do everything that you promised in the campaign. There has to be a feel-good factor, a feel of prosperity. And right now, there isn't that feeling of prosperity. So I think that over the next year, till the midterms come up, they'll be very focused on real wages, earnings, trying to make households and consumers feel more comfortable with where they are, kind of like they were actually before COVID in the first Trump administration.
Right.
Okay. Steve, hi, morning. This is Harsha. Steve, give us a sense on what's playing out where the Fed's mindset is concerned, in your opinion. This obviously reduces the chances of a rate cut, but by how much, and how should one look at the slightly medium-term outlook where Fed rate cuts are concerned?
Oh my, that's a 2-hour question you're asking, not a 30-second question. I think there are a couple of things that are surprising the market. One is that normally, if you're an FOMC voter, you play it pretty close to the hip, because if you come out super hawkish, and say they decide to cut, you're kind of forced to dissent. And so normally they leave themselves some wiggle room. And what's surprising, and I think what's impressing the market, is how they are not leaving themselves this kind of wiggle room to maybe compromise and cut, but then go on hold. So I think the market is concerned that they may go on pause in December, and if anything, next year's FOMC may be even more hawkish than this year's. And I think, having said that, I think there is a problem in that it's quite possible that when we get November numbers, right? So not something we're going to get in the next 2 weeks, but say something we get in early December, those may be quite weak. I mean, one thing that's very clear is that holiday hiring is very, very weak this year. You have to go back to 2011 or 2012 to find such weakness. So I think it's possible that they should be saying data dependent. Instead, they're kind of pre-committing, and they may find themselves sort of trapped, having made these statements going into FOMC if the data come in softer than they expect.
Interesting. Steve, great to have you today on ET Now. Thank you so much for that insight.
Thank you.
Okay, let's just revisit what the GIFT Nifty currently is indicating, because